we need, okay, some process is being followed somewhere in the world. Should we just tag on to it with some tinkering, or should we have our own new course? That is to be decided.
Two pieces would happen.
Yeah.
Two pieces would happen, sir. One is we give perspective of generally they should do beyond what is there. But because the primary advisory committee has already decided on certain aspects, the inputs, whatever observations we shall give, the others can always be there, will be limited to those 4 specific points itself. But yes, as Reddy said, it's open-ended. We can give our multiple thoughts. Yeah. So yesterday you saw the articles of the way the new age stocks have been collapsed. I sent you.
Absolutely. Yeah, I looked at it from a fundamentalist point of view.
Okay.
And I've seen over, over 2 decades in the lending side,
Okay.
and then about 9 years in the corporate side in the top management, and of course 4 years the ARC, and after March 17 as a insolvency professional.
Okay.
So whenever a funding is being done, see, the thing is, when lenders are funding it, they are unconsciously valuing it. Whether it's corporate finance or it's project finance. Project finance, it's very explicit valuation. Corporate finance, it's implicit. Why I'm saying explicit, the moment you're talking of IRR, you're talking of, finding out the cash flow for the life of the firm. Only thing you're discounting at a rate which is going to equal the present value to the investment. So the NPV is 0.
True. Yeah.
So you're valuing it, but you don't say you're valuing it.
Yeah.
Right? And how wrong we've gone over years. So anyway, you tell me and we'll get started.
Okay.
Leave it. You can just take 2-3 sentences. I'm a senior citizen with more than 4 decades of background, including my start was I landed in Bangalore on 19 July 1978 to join Hindustan Aeronautics Limited as management trainee.
Okay.
So that was my first start. Then I opted for
which year? 1978?
1978. Some of you might not have been born, or must have been very old people in the previous birth. But anyway, jokes apart, if somebody is very old in one birth and if that person has to take the next birth, it doesn't happen so soon. Yeah.
So, Shiva,
good morning, everyone. It's my privilege to introduce.
Voices.
Good morning, everyone. Is it better anyway now?
Perfect. Perfect. Please limit to 3-4 sentences. No need for a bigger one.
Good morning, everyone. Is it better now?
Yes, perfectly okay.
Yeah.
Good morning, Shilpa. You're audible.
Yeah. It's my privilege today to introduce today's speaker, Mr. Rajendra M. Ganatra. As you can see, his educational qualifications are amazing. He has done his BE Mechanical from VNIT, CAIIB. He has done CFA, and he has done PhD Management Studies from NMIMS University, Mumbai. Over 3.5 decades in recovery and restructuring, project finance, asset reconstruction, and corporate insolvency resolution, including as MD and CEO of India SME Asset Reconstruction Company, promoted by SEBI and banks after initial 5 years as engineer. He is an insolvency professional, handling various assignments, including Raj Oil Mills Limited, Sunshine Housing and Infrastructure Private Limited, Mayurpank Fine Builders Private Limited, and he has handled advisory assignment under IBC successfully. I'm really impressed, Mr. Rajendra, with your resume, a very fine resume, rather profile. And he's a visiting faculty in past at IIM Indore and Sambalpur for project finance and mergers and acquisitions. He'll be shortly handling project appraisal and finance at IIM Trichy. Over to you, Mr. Rajendra. You can first tell the participants about the today's discussion objective and then go ahead with your advice on SEBI recommendations.
Thank you very much, Shilpaji, for such a lavish introduction. Good morning to you and everyone. It's a pleasure addressing valuers whose services I have always enjoyed availing of in my lending business and also now in my insolvency resolution. And the objective of this is to discuss the recent consultation paper of SEBI on basis of IPO pricing. You're aware we have to give our observations by 5th of March. So Mr. Ganesh suggested that we have this webinar. Discuss and come up with our consolidated views. Why this came about? I wrote one article on this PayTM. I call it PPayTM, 197 communication. It so happened I read Shamal Muzumdar's piece in Business Standard. So there he said, how the guru of valuation, Aswat Damodaran, had suggested to this gentleman, Sharma, to focus on business rather than bluster. So when I saw that, I said to myself that it would be a better idea to comment on the valuation. So I gave a call to Debashis Basu. You are aware, Debashis Basu, Suchita Dalal, the husband, wife, and they have this Money Life Foundation. I said, why don't you write now? This is a good article and you always have your piece in Business Standard. Why don't you write, comment on valuation? So he turned the tables on me. He says, why don't you write? I said, okay, if you wish so, I'll do that. So that's how I wrote. And when I wrote, you will, if any, like Mr. Ganesh has seen and those who have seen would, treat me as a fundamentalist. Yes, I'm a fundamentalist when it comes to investments. So then Mr. Ganesh suggested, why not we have a chat together? We had a very long chat on this. That's where we are. So I'll just give introduction. And then what I'm going to do is I'm going to open my this particular consultation paper. I've shaded certain portions. I put my comments also. My comments are my views, but this is open house. So I'm going to share my comments. So the paper seeks specific comments on certain paragraphs that of course we will give. I think nobody can stop us from giving something additional. I was just mentioning about tinkering or making a radically different, view in this matter. So I think as we go on, we will come to our conclusion. All right. When we look at valuation, it comes, whether we are in the finance world or even in the social world, valuation is an ongoing activity. We don't even have to keep our cash with us in currency because again, there's a risk. So we have to value keeping cash or investing somewhere. That's how it is. And what I have seen is that I was telling short while ago before I began, as lenders, when we did project finance, we unknowingly did valuations. I'm saying unknowingly because we didn't call it valuation. We said, well, we are calculating viability parameters. When I'm calculating my viability parameter from the company's life cycle point of view, then obviously I'm doing my valuation. If it's an IRR of a project IRR, then obviously I am doing full-fledged valuation and discounting at a rate which will equal the present value of the entire cash flow over the life to the investment. Well, if it is mergers and acquisition, again, it's the same thing. And I'm sure you are aware that at least the worldwide, mergers and acquisition deals fail 50% or more times, and major merger of equals fail. And one of the biggest failures of the mergers of equals we have seen, I'm sure you're all aware, it began in August 2016, and now it's a failure. I don't have to name it, but nevertheless, since we are not having a dialogue on this, I'll name it. I was, in fact, handling the M&A classes for IIM Sambalpur in August 2016, when the news came about Idea and Vodafone merger. We all know the details. It failed. So that fails. Reason being that in M&A or even in project financing, the deal making takes precedence over the due diligence. And that's where the failure occurs. Now, coming to the valuation for IPO, it's a different case if a company is existing, it has notched up a record of performance, right? But when it comes to the new age companies, when there is no record of performance, the circular, SEBI circular itself says that, look, yeah, okay, fair enough. The SEBI circular itself says that these new age companies need to be treated differently. So here, yeah, new age technology companies, that's what it is. Shall I, Shilpaji, shall I project my thing? I have some shadings done there. I'll just do that. Well, where is it? Here it is, right? Sorry.
It was also circulated for the benefit of
yeah, that's right. That's
participants along with the flyer.
That's right. That's right. Right. So I've just projected this. This is a Harvard case study. I'll not be able to do much about it. Will not be able to share this paper. We'll do something about it later. I'll interact with Ganeshji on this matter because there are copyright issues. I just want to, before I start on again on that, I'll just point out here. Here there is an ABRY Partners, Boston-based company, which was, in the US, the private equity companies, the hedge funds do a lot of leverage buyouts, management buyouts. Here, a private equity firm took it over, only to review later that the accounts were fudged and it failed in its due diligence. Subsequently, the matter went to the court and there was a settlement where the other party gave a part, but the private equity fellow lost it out, right? That was the only thing on this matter. And coming to the circular, SEBI circular, what we are trying to do, new age technology companies, when we are talking of the companies, the ventures which have been funded by the venture capital companies, the venture funds or the private equity funds. By and large, of course, the private equity fellows come, as you are aware, towards the last mile so that, they have a clear exit. Venture capital funds, venture funds in comparison are patient. So that's why it's called patient capital, as you know. Point there is that once they fund a new age technology company, they do their due diligence definitely. They also look at the possible returns. They look at the kind of risks and risk-adjusted returns they seek over their investment horizon, which we are aware of. The venture capital formula is known to us. On that basis, they fund and they acquire ownership to the extent the valuation dictates. I have mentioned also in my article. And they monitor it, and over a period, depending on the performance, the variance between the estimate and the actual, they decide to have higher or lower ownership. And often, as you know, these funds invest in quasi-equity to begin with, so that they can convert it at an appropriate price. More often, of course, they put equity. But all done, they also know that very few are going to be the star performers. substantial numbers are going to be living dead and the rest are going to perish. So when you talk of percentages, it's generally known that 1 or 2% will be big successes, about 10% would be living deads, and the rest would be perish. Now, the point is, when such company is going to the public, does the subscriber have the benefit that a limited partner or subscriber to the venture fund has? When I'm subscribing to a venture capital fund, I have the benefit of the portfolio. I'm having ownership to the extent of my subscription in all the investments, indirect, of course. And should some fail, I'm going to be compensated by others. That is not so when these new age technology companies list. So the point here is, though of course SEBI has not sought, any comment other than the paragraph that they have given, I would request that this open house also discusses whether we should ask SEBI to go beyond what it has mentioned. And when I say go beyond, I would feel that there is really no merit in allowing new age technology companies to list before they demonstrate a performance for at least 2 to 3 years. I'll leave it to you. Now, let me just scroll this and then discuss. This is what it is. He's talking of the investor ICDR regulations, where there are certain ratios mentioned, very crucial ratios: EPS, PE, return on net worth and net asset value, and comparison with peers, of course. This is the background he's saying. And ultimately, this is the format which he has mentioned to capture this. Fair enough. If anybody can give this, it's perfectly okay. Ultimately, he's saying that these do not relate it to the issuer, that is loss making. And loss making is allowed because new age technology company is a bit different, where investors are onboarded on these companies on the premise of future potential, and accordingly the company strives for long-term market leadership rather than short-term profitability consideration. I have a short issue with this. One, the investors are onboarded as the limited partners, as the investors to the fund, right? They look at the long-term market, of course, long-term valuation as, the quintessential values, you would say the long-term valuation so that they can exit, right? They can exit means the fund can exit, and that profit will more than compensate for the losses in the living debt and the debt companies, debt investments. That's what happens. It doesn't apply to the new investor who comes in the initial public offering. Then the growth in such companies comes from expanding into new, which is a very general statement, so I have not shaded it. Now, IPOs globally follow disclosure-based regime and prohibit any future projections. Well, in fact, if you remember, years ago, SEBI was allowing future projections, then they were stopped. The point is whether, the second point which I want to make for this group is whether we should insist on future projections. The reason simply is one, that when any fund is investing, no fund can make an investment decision purely based on qualitative discussion. There has to be the qualitative, the business factors must be translated into figures, and they do it. We are aware of the venture capital formula. I'm not projecting it because you are all valuers, you know it very well. If you know Paytm's lowest price per share was 50 paisa per share of the face value ₹1, with Vijay Shekhar Sharma, the promoter, who no more remains as a promoter, he remains as an investor and of course the CEO. And the highest was 1,880 by the later entrant, the fund, right? And with an average of about 816 rupees, right? How did they arrive at these valuations? They did arrive based on some valuations. Only thing is when a single scenario is given, that may create a problem. We may say, give the most likely scenario subject to assumptions, the downside scenario subject to those assumptions, and upside scenario again subject to certain assumptions. Probably we can ask for that. Now, here, traditional parameters, trends, valuations done on the earlier rounds of fundraising. So earlier rounds of fundraisings, how are they done? They cannot be done without the DCF. Ultimately, everything has to be translated into a figure based on the discounted cash flow model. So that will have to be seen, and market conditions. Now we come here to this disclosures on the basis of issue price section. How the loss-making companies are required to be supplemented with non-traditional parameters as key performance indicators. Now, when we are talking about the KVI, and we are aware here, the subgroup of the primary advisory committee of SEBI came up with something. This, as Mr. Ganesh was mentioning, disclosure on the basis of issue price section in offer document, basis of KPI. And this document will provide disclosure of relevant KPI, including material KPI made before pre-IPO investors during 3 years prior to IPO, explanation of how these KPIs contribute to the firm. Here I have given my comment, which says, let me just open it here. Contribution of KPI to the issue price entails DCF. That's what I'm saying, discounted cash flow modeling. In the absence of DCF, no basis can be arrived at. This is my view. Can we have this way? Can we do this way now? Since now we have come up with these points, can we start discussing these points right away? Or you want me to, that I finish my comments here? What would you say, Shilpaji, Mr. Ganesh? What would you say?
I think we should have each point time itself discussion so that we don't lose the thought.
Right. So can we begin with you on this?
Yeah, I think undoubtedly the details of the discounted cash flows or the projections that are going to come has to be there. And the critical aspects is, in my view, the limited partners of the venture fund, when they invest, the kind of protections and using liquidation preferences they set up when they invest are all not known for a common investor when they invest. So they are absolutely exiting. And when a normal common investor invests, at that time they have no liquidation preferences, nothing. They are like a normal investor and they have only downside risk. They have no protection from the downside. Unlike when these liquidation partners got, these LPs have got it when they have invested. I think that's why it is extremely important that they do mention all the projections, they have it, and what are the measurable indicators that they have looked at it when they have invested, and how those indicators have actually performed in their investment time frame. I think that is important as a disclosure in my view.
Yeah, they have protections. Aside from that, they have tax breaks at the fund level in India also. At the recipient level, even in other countries, we don't have at the recipient level tax break. Like, when the limited partner invests, if the NAV comes down, he gets, deduction for that. Here it's not that, but at the fund level, there are tax breaks. So they have protections. They have some incentives as well. The normal guy doesn't get it. Any other views on this? I think, since I'm projecting it here and I'm not able to see others, what I'll do is, whichever is very crucial, I'll ask. Otherwise, I'll first finish my points.
Yeah, I just have one point, sir,
Yeah.
just to add on. Several investors who have invested in the initial round would have placed reliance on, the projected financials, the discounted cash flow, basically. And again, when this company is going, any company is going public, obviously there will be some sort of evaluation that will be done based on a DCF. Now, should there be a small note or a write-up that should be included just to mention what is the, how the company has actually fared? In the sense, it is like, let us say, the company is say 7 years old, and in year 2 it has actually raised some funds. In year 2 it has actually, there was a DCF that was prepared, and there were some parameters, the company would have estimated, the cash flows based on certain performance. The cash flows, as per the projections, to the cash flows which the company actually has achieved. That is one of the points. And of course, now what is the future projections? Should that be, just to understand?
Yes. I just, as you were talking, I just picked up my diary. I'll just make a note of it. So
Actually, I want to make a small correction here to what Kusum has said. She lastly concluded saying projected cash flows versus actual cash flows. Maybe, they may or may not have achieved it, but more so followed by promised milestones and achieved milestones. How far they have flared vis-a-vis the cash flow, because sometimes cash flow could be misleading.
No,
see, one thing I want to add over here, basically when you look into the way of investing of these investors, which are sophisticated investors. So primarily, I understand probably the cash flow might be important, but the kind of cash flow which they look into, does not look into cash flow beyond 1 year or 2 year, right? And for sure, their conclusion does not depend on cash flow. So it depends on the current run rate, current milestones, and and kind of a growth which are there in say a year period, and what kind of market opportunity you have, and who are the competitors. So probably focusing too much on DCF is itself a parameter which is not used by investor, probably might not be. That's my thought process.
I just add two points to this. You're right. It's very difficult to make a long-term projection, even for an established company, much less a startup, definitely. So what happens is, in fact, I had picked up one such investment by private equity in one company. So what these guys had done was, yes, they had used the venture capital formula, but they had, what they had done was fair enough. They said that, okay, based on today's investment, today's projections, this much I own your company. I'm going to monitor you year on year, and accordingly my ownership would increase. And then the performance deteriorated. So the fund ended up owning more than 90% of it. So yes, we have challenges, but the point is, let the investors know that there were, models done by them. And see, again, the point is, you hardly find a fund which is sector agnostic. They always are, specialists. So they have people who understand, who analyze, who come up with figures. Figures are going to undergo change. And how the other investors come in, see, in case of 197 Communications, leave aside the promoter who got at 50 paisa. But the initial fellows had paid less. The latest entrant had paid 1,800 rupees per share. I'm sure definitely he would have done a projection with the aid of his, team. So it's a good idea to say that, look, not only mention how, various investors have come in and how they had valued, and give a small note on that. Yeah.
No. I was just responding to also to one of our colleague here. See, what is important is we are not only asking about cash flows because investors does not look at it. It is important that when it is getting listed, people should know the basis. Suppose if an investor has valued a company purely on number of users, let's understand that as a basis. Let people know that the valuation was based on users. We are not saying right or wrong. I think the end user will have a luxury then therefore to see, okay, this valuation is done based on users, whether I am comfortable or not. Today, all that is not known. Therefore, whether it is a cash flow, whether it is a user, people that those disclosures of the basis of valuation must be there. And if that is the basis they've invested, how did the company perform then? Which is what I think Shilpa said, promise, and Kusum said, promises versus their performance. I think such disclosures should be there for these new age companies, at least in my view.
Added to that, what happens? See, one might say that no investor looks at the RHP. That's a fact. But at least the analysts will pick up and publish their views. If you look at 197, there were not too many views floating. So BRLMs had done a great job in the market. But at least there were people who said that maximum you could have a listing gain, if at all. Nothing beyond that. Recommendations were not there. But if this information is given, people will say, look, it has consistently failed in delivering what it promised, or it has succeeded in doing so. That will aid a possible, possibly the investors who are very gullible, who get impressed by the blitzkrieg of the advertisement. Fair? Now, some KPIs, yeah.
So just wanted to understand here, relevant KPIs. What are these KPIs? Who determines the KPIs? And how do we ensure that they are relevant? I mean, how does it?
Now there are a lot of things here, Ultimately, the key performance indicators, we all know what those are in terms of, money. Point here is that they are saying that the KPI should be disclosed, material KPI, and then how are those KPIs which the issuer company deems are not relevant for the proposed IPO, he'll provide, he need not give and provide explanation for considering this KPI as not relevant. I don't understand why it should be so. Leave it. This para should be deleted at all. Why should it be? See, that's the problem, is that the moment this kind of liberty is given, nothing will come. If you look at the DRHP and RHP of PATEM, there is absolutely nothing there. Coming back to your point of relevant KPIs, yes, the KPIs also can be defined, but the risk is that it can't be all encompassing. So probably we can tell them anyways, give a
can
indicative list.
KPIs be determined sector wise? Can SEBI define those?
Probably it can, it can give some finance KPIs. Otherwise, there would be some, sector-wise operational KPIs. Those can't be captured. It's beyond anybody's capabilities of doing it.
Or can there be another?
Basically, what we can do. So whenever we look into these kind of companies, so they have an independent board over there, right? And whenever an independent board look at the KPIs, the kind of KPIs is being looked and overseen by and monitored by the board can be considered as a KPI relevant for the purpose of this clause.
Yeah,
so and sometime investor might go into much more in detail. Probably, as an investor or as an analyst might not be able to follow that, but at least the bare minimum set of KPIs can be those which has been reviewed by the board of directors.
Yeah, so that's what it's essentially is. KPI stated by the issuer company shall be described and defined clearly, consistently, and precisely. KPIs should not be misleading. So it's fair that it has been left to the company. It will capture the sector specific and financial and other performance KPIs. So fair enough, it can be done by them.
And Rajendra sir, please help me understand, because I have not really been following this, how this listing process happens. But my understanding is all these RHPs and DRHPs will actually be reviewed by SEBI before they're allowed to be published, right? I'm just assuming that is the process. Is my understanding correct?
Yeah, DRHP is submitted to the SEBI, and the SEBI looks at it, but SEBI essentially looks at compliances part, It really does not see if you're given some figures, it looks at the basis for those figures, where, okay, they are or coming from audited accounts or not, etc., etc., etc. If there are any legal, cases going on. So disclosures and compliances, it does not vet those figures.
No, that is perfectly fine. My thought process was, can actually SEBI come up, every time, there is an application that is made. I'm supposing there can be a committee that can be constituted, which will review and which will actually insist on particular parameters to be disclosed based on, the sector, which the company wants to list in, or, this is what is my thought process.
Uh-huh. Well, we wouldn't know whether, after looking at the draft red herring prospectus, whether it asks more. Yes, it does. If you look at, the DRHP and RHP, both, if you see, not much of it. Why much? I would honestly say I didn't see any difference. Apparent difference was not there, even 197, when I saw both the documents. But what you're saying could be a good idea, but nobody can force SEBI to do that. It will be very tough one for them.
So that is an extrajudicial power. I think SEBI cannot have it because end of the day, when we are talking about listing, that's an independent judgment of people who wants to invest. What SEBI is looking at it, the guideline that it is laying for every company who wants to list their particular company, those guidelines that they are following. What is important is, suppose if these guidelines, they say that in this list, normal profitable entities, they say PE, EPS and all, they are asking for the startup companies. As long as these are listed, SEBI cannot again further look into and give certain comments. And that is left to various analysts and individuals finally to take a call. So from that perspective, SEBI should not go beyond their duty or their limited right they have, just apart from managing compliances.
Actually, this is captured in the next point here, which you can see on the screen. All KPIs to be certified, audited by statutory auditors. Comparison of KPI with Indian listed peer companies and our global listed peers wherever it's available, and comparison of KPI over time to be explained. Good idea. My comment is here, this should be deleted since this does not match with auditors' expertise. I would not say deleted, they should be modified. Instead, the BLRMs should be asked to attach fairness opinion, or maybe fairness opinion should come from independent merchant bankers. See, and as auditor, business is very different. How should the auditor get into the certification? Probably valuers can do that job. So this is important. Don't burden the chartered accountants with things they are not into. Barring some firms which may be there, some chartered accountants will be valuers. But this should be, when you're talking of KPI, and the whole thing relates to pricing, valuation. Why should an audit firm should be here? That's my point. So we can comment that this should be, done, certified by valuers, number one, and this should be backed by fairness opinion. It's a different thing that fairness opinions, it's a moot point whether fairness opinions add much value. But at least somebody will have to apply mine. Statutory
So
auditor.
please excuse my ignorance, but please tell me, what is BLRM?
Book running lead managers.
Okay, sure, sir.
Yeah.
Thank you.
So book running lead managers will definitely cause a conflict because he has interest, he's taking fee. So it can be some independent merchant banker. But basically it should be done by valuers or valuation firms and backed by a fairness opinion from independent merchant bankers rather than book running. It's BRLM should have been. It's an error. Book running lead managers.
So I have a point to add over here. Probably,
yeah.
I completely agree. Probably that auditor might not have expertise, but to be honest, I'm not sure whether valuer have expertise or background to that. Correct. Because see, so there are two. You understand all of these valuations. Are there is a significant aspect of negotiation. I understand valuers are good at their part. What they are doing, I'm not demeaning them. But the kind of KPIs which you're talking about, if anyone
can
has to
you
come
keep
and
your
say
video
35%.
on? If you have bandwidth, if you don't have bandwidth problem, can you keep your video on?
Sure, sir.
Mr. Ramesh.
Yeah, I can do that.
Yeah.
Am I visible?
Now let me.
He's our veteran BVA member who has done very big, profound startup valuations.
So then, okay, what are your views? Those should be captured, and what are your views?
So honestly, that should be captured. But why we are not placing reliance on the management? Why we want to say they are? Why we want to say that we can't rely on them? So everyone is willing to put money on them. So I think this should not be very much bureaucratic, and probably we have to look into from a global practice also. I'm not sure, to be honest. I have not seen US or UK regulations, but what I understand, they are very, very investor friendly. And if they are investor friendly, why we are saying that someone will come and audit it? The management is the best expert in that, to be honest. So no one else other than management is expert in that, and we should rely on them. So to be honest, when we are putting money to them, we should rely on them. It should not that some auditor or valuer will come and certify. We will have a more comfort on that. But to be honest, it's integrity of the management. I also invest in some companies. I think integrity is one of the most important thing which I look while investing. Agar promoter chor hota hai, to whatever cheap valuation the company is available, no one want to touch those companies. And there are thousands of companies which are there.
I'll just supplement what Mr. Ramesh has mentioned. First, I'll give an example. Like I often say that the valuation of the inventories, receivables, particularly inventories, should not be done by the statutory auditors. These should be simply certified by the management, and the management should be held responsible for the fall in the value. Because valuing inventories is frightfully difficult. If I am good in steel, I can probably value the steel inventory, not others. It requires domain expertise. So that's what I often say. I think what Mr. Ramesh says is that we leave it to the management, whether integrity or not, at least they have the domain expertise. What's the point in auditing? I do agree. We can even ask we can suggest that this should be deleted. Why you make it bureaucratic, create other source of revenue for some firms? Leave it to them and let the analysts rip them apart if there is something wrong.
Sir, may I say something, sir?
Yeah.
Yeah. With due respect, sir, I think first principle when you see here is when the management is certifying it, and we are expecting, why does this entire SEBI paper come up? Because they are saying that the level of risk appetite between a common investor who invests versus a specific qualified HNIs or qualified investors, there's a difference, and there has to be a protection to a particular common investor. That was the basis. Primarily because of the information arbitrage that is there between a common investor and the qualified or special investors, a premium investors. That information arbitrage, if it has to be minimized, and they should be coming at par in terms of ability to take the risk, the common investors risk require certain kind of a confidence building measures. So the certification outside management is primarily a confidence building measure. Now, who has to certify it? Here, what we are saying is there are KPIs which are disclosed by the management and which are evaluated by the board periodically over time. So those are measurable indicators. Now, whether those measurable indicators have performed or not. So here we are not looking at business aspect. We are looking at the factual aspect of the KPIs. So the factual aspect of KPIs is on a month-on-month basis, I have 10,000 users gets added. It is not a domain knowledge. It's a factual knowledge about whether that is getting added. So whether it is a statutory auditor, whether it is a valuer, whether it is any other person, they are actually giving a factual check and certifying it. That's a confidence.
Not projected KPIs, it is the existing KPIs.
Exactly. So I think my take in is key. I think this particular statement in the SEBI discussion paper stems from that, saying that whatsoever as board, because it's always a known fact, a related party or a party of interest should not be the basis for certification, especially when others are put at risk here. So here, the common investors are being put at risk. So I believe there has to be a certification. It's not about integrity. You should consider it as a confidence building measure. And
Okay. And conflict resolution, you say you don't want a conflict of interest.
yeah, and so because of that, I think even auditors can do it, because audit, it's not about the audit as a profession. What it says is someone verifying facts versus reality. So anyone, and therefore a statutory auditor who is already doing a facts versus reality as far as accounts are concerned is capable enough, because he has access to the information to measure this also. And he's not commenting on it. Commenting is always done by analysts outside as regards to those KPIs and everything.
I think fair. I think that's a good suggestion. Only thing, my point was, why you want to make it bureaucratic. I probably understand. So, is this the best practice that is being followed globally? If it is yes, continue it. If it is not, India is otherwise, anyways, and not so exciting market for IPOs, at least for startups. So entire thing has to be looked into from that perspective. Otherwise, a lot of companies, as of now, also externalization is happening, right? And going forward, it continue to do. If you are creating a lot of barriers, probably yes, for sure, small investor protection is most important. But you have to look things on holistic basis.
Right. So
Yeah.
I think
I also have a question
Yeah.
to either to BVA or to Rajendra sir, to yourself. Mr. Romesh was actually talking about what are the practices that were followed, that are being followed outside of India. So, do you have any insight into those practices that are being followed? Because it is not the first case where a company like a Zomato or a 197 has got listed, right? Similar companies would have got listed in other markets, say the US market or any other European market. Any insights on those?
I think there are close to 10 companies which are listed, which includes Delivery Hero, Deliveroo, Grubhub. So I think there are many companies. But to be honest, I have never gone and looked into their offer documents. So probably someone who is more inclined towards research.
Outside India, see, the thing is whether similar practices have happened.
Yeah, there are 10 companies, 10 to 12 companies like Zomato which are listed. But to be honest, I have not looked into their.
Can I answer on this? Ramesh? Or can I answer Kusum on this, sir? With your permission, sir.
Please, sir, go ahead. Please, sir, go ahead. But this is, I was just sharing my thought process.
Yeah.
I mean, probably pretty open and want to learn, because still I'm a learner in this, and this is
all learners. It's lasting pursuit.
See, I think one classic. Since Ramesh has raised thing about international and Kusum was seeking clarification, one of the classic case, the difference between the Western or the developed markets and us is the recent conviction of the lady who was a billionaire, but who has defrauded investors in terms of disclosures. She is put behind bars. I forgot her name. I think
I remember this is a medical
yes.
laboratory.
So therefore, Ramesh,
medical device.
The biggest difference between the Western and developed world markets and us is the kind of penalties that are there for a fraudulent disclosure. For a performance, no one questions it. For a fraudulent disclosure, especially, is so severe that people think twice to do something wrong severely, and therefore markets have evolved to accept based on the risk appetite, and people invest through various mediums of institutional investments. Whereas in India, it's the other way around. People are left high and dry big time, and therefore we need protection mechanism unless we fix the other side. Now you can say, fix the other side, why are you coming here? That's a chicken and egg, which will come first. But until we have such kind of a protection mechanism on legal side, or on any fraudulent activities, we need to have this kind of some kind of a protective mechanism, is in my view.
So I completely agree with you, but kind of see, if you look into the kind of retail investors which has entered into market since last 1 year or 2 years, so probably it was I think 2 years back it was close to say 3 crore. Now it is close to 8 crore investors. Probably a crore here and there might be there, right? So when you look into the depth of market is increasing, correct, and there has been significant participation and kind of money that is going into retail investor money going into uh, uh, all of these. Probably our market, I believe, is getting a lot of depth. So it's not something which is used to be. Yes, I would. To be honest, I think uh, uh, I agree with some of your points. They have a lot of merits.
Yeah, Ganesh, I now remember it is Theranos. That is the name of the company. And it is that Elizabeth Holmes is the name of the lady who is the, who is the promoter of this company.
So nice
Yeah,
question. I think,
Yeah.
sir,
The-
if you go back to 19, sorry.
The US regulations, of course, from after this discussion, I think I would myself would like to go through and see that. But kind of Paytm kind of issues do happen when Freshworks, a SaaS story, which was listed on the Nasdaq at 36, had peaked to $47, and now it's $22.50. So yes, the new age technology companies are the flavor, and they get listed. The listing norms are undemanding for them. So in that sense, it's a good idea that we are now talking of, we have a chance to respond to this particular.
So Rajendra sir, another question following all of this discussion is, what are the penalty clauses, to the promoters? Have they been actually listed in this disclosure documents?
Penalties for what? Like if there are any,
For false representation, misrepresentation of facts, whether if it comes, if it comes to the knowledge either now or in future, still, whoever is responsible for, disclosing, they will be punished, and those punishments should be very severe, and because that will actually act as a deterrent to mislead the public, isn't it?
Well, SEBI has even judicial powers. In fact, I'm not aware of the penalties which results from misrepresentation, but they are. One can look at it. I'm not aware of that right now. Well, yes, but what happens when the SEBI is looking at the draft red herring prospectus? It is supposed to make sure that disclosures all come, and despite that, if something is misrepresented, yes, and if it comes to light, there would be penalties. How severe those are, those can be seen separately, and representation should be made with SEBI going forward. Anyone is aware of these? I am not aware of these. What
No,
penalties?
there are SEBI rules, authority guidelines clearly dictate various, penalties, but it is, there is a clear section 15, section 10, 11, 12, 11 and 12 are charging sections, both for any fraudulent activity, either by the investor who is trying to defraud, either by illiquid market trading or something. There are very clear guidelines on that in terms of SEBI Act. But more importantly, I think at the discussion paper level, I think we are seeking at this stage, it is SEBI saying whether all disclosures are done, so that a common investor, when they're investing it, they are aware of the risks and they're entering in. So as regards to the fraud part of it, whether it's a new age companies or the old traditional companies, anyone who defrauds, anyone, there are normal penal clauses, all such are there. It's agnostic of whether it's a new age companies or otherwise.
Fair enough. I think it's been a very good discussion. Now we'll come specifically to the public consultation, and we'll quickly come to the conclusion. 421. Is there a need for disclosure of KPIs in the basis for issue price section in the offer document by the issuer company? That's the first question. I think 421, the answer is obviously yes.
Yes, sir.
And what I had meant, this is needed since it will facilitate analysis of the investing company and eventually reasonableness of what I mentioned. I thought reasonableness of the IPO pricing. So everyone would agree, yes, these are necessary. I think we already discussed what more can be there, how it can be elaborated. Now, if yes, this is the second point on which we have already talked a lot. Now we can conclude ultimately. So what it says, whether it should be audited by uh, statutory auditors or certified audit by independent chartered accountant. What is the view here? I had mentioned it should have nothing to do with it. It should be backed by, again, there was an error, BRLM, not, but I would not say BRLM. It can be a merchant, a banker, or it can be management declaration plus an independent merchant banker kind of a thing. This is what I feel. Now we can conclude it in the next 2-3 minutes. What would you say? As we agree, yes, there should be certification, right?
We can
Yes,
also
sir.
By
say
whom?
registered valuers over here.
Huh? Valuers, yeah, okay. By valuers or valuers or valuation firms, right?
I think there should be certification of KPI, but whether it is a chartered accountant or a cost accountant, it depends. Correct? Cost accounts are much more capable of doing that because they are into that area of analyzing cost,
Yeah,
analyzing.
the managers.
Yeah.
Okay. So one can say valuers, oblique management accountants. See, nowadays, even the Institute Cost Accountant of India prefers to call it itself a management accountant. So, instead of cost accountant, the word can be management accountant. Managerial accounting is very crucial, of course.
Yes, managerial accounting talks about KPIs, the drivers, and how things are
Yes.
going.
Yes.
So those are the things that would be relevant.
Yeah.
And here we can say that not only chartered accountants are also capable because they are doing consultancy, they are doing when they are not doing auditing. Right. So they are capable of doing that. So those are the two streams. I would not think valuer. Valuer is giving an opinion on the. They are not. I would say they are not designed to go into accounts and then analyze things and then say that this is right, this is wrong, or this is okay. Correct. They're taking a view or opinion on the cash flows or the market or the relative things. So probably these two professions I feel is a better bet on 4.2.
I'll just add one thing. Like when you talk of KPIs, you just mentioned drivers. And if you really look at revenue drivers, and which, see, ultimately, when you talk of drivers, whether revenue drivers or anything, they should lead to return on equity. That's the fundamental. And you know very well the Compaq and Dell comparison typifies what the drivers can achieve. How the leverage was, helped Dell, how its lower working capital led to its higher, ROE, etc., is well known. In fact, there's a beautiful case study also for classroom teaching, which is by Harvard. So my point here is that, see, the moment we are talking of the KPIs, which will include even the drivers, which maximize return on equity. And ultimately, when you talk of return on equity, then another thing is the growth opportunities. That's why you're talking multipliers. So in that sense, when the valuer is looking at it, valuer is combining all the factors into one quantitative parameter, that is the share price. So I would feel that, yes, if a valuer is there, valuer can't do mechanically. He can't simply pick up an Excel, or for that matter, anybody. Something is there and he'll just clarify it. Anybody who certifies will have to really spend time to figure it out. In that sense, I feel valuers and valuation firms, or of course, we need not say that the CA firms have nothing, may not have anything to do. Let them be there, but there are others who can do better. Can we do that way? Can we say valuers, management accountants also, or can we add independent merchant bankers?
Merchant bankers. Yeah. So that is there. Yes, merchant banker do a lot of data crunching.
Yes.
But
So,
what do you think about this? That when we are saying that we are taking a view based on the numbers presented by the management and saying that this is the value of the company, and here we are certifying the same numbers by looking at it. Would there be any conflict of interest saying that we are doing work for the management also by way of certification and then doing valuation? I mean, from the valuations guidelines standards perspective.
uh, what would you say the valuation experts, Ganeshji, what would you say?
I think, I have a slight difference with this. Whether it's a valuer or statutory auditor, it's a fact finding. Suppose the management says the KPI is simply number of people who are what is the attrition? If that's a KPI, then it's fact finding of how in the last couple of years management has disclosed that we had 20% attrition, whether they had 20% attrition or not. If the KPI is number of the growth in the stores in revenue, or those are the KPIs management dictates, the board decides. So it's a fact finding exercise in my view. The moment it's a fact finding exercise, it is, for me, it's simply a statutory auditor is good enough. You don't need any one person. They are not commenting. I mean, I beg to differ with you, sir, on the return on equity or other things. They're only saying whatever KPIs management is talking, and the board used to look at it. What is the someone is certifying that? Because statutory auditor today is certifying the books of accounts. He is not certifying the KPIs. We need that also to be certified. I think that's what the intent is in my view.
So can we say add independent merchant bankers, valuers, cost management accountants?
So let me,
Certifications?
can I just add?
Yeah. Yeah, yes, please.
So see, the thing about, you had raised one point briefly, Rajendra sir, which is that KPIs, we are using certain parameters outside of KPIs actually to do a valuation. So therefore, this term KPIs itself is a misnomer. We should be actually saying valuation metrics. That is the basis of the issue price is a valuation metric. It's not a KPI. So for instance, suppose you have a debt ratio. That is not a KPI, which you can compare between companies. Now, the second is that all of these people whom we are talking of as being independent experts who will value whether the issue price is right or not have zero skin in the game. Now, what needs to be done by SEBI is to make sure that the person who is certifying this is one who has a skin in the game. So rather than an independent merchant banker, for example, it should be a person who is actually investing in the issue and he is fixing the issue price for subscription by himself. So either it is the merchant banker pushing the issue who is also going to subscribe to the issue and who is also underwriting the issue. The person who has the most skin in the game is the underwriter, because if the issue devolves, it falls on him to subscribe to the issue. And he is the right person to fix what is the price. Okay, so this is typically the situation even abroad, where the underwriter is the one who ensures that the issue is successful and then the issue gets sold to private investors. So this, I think, is the key thing here.
Okay, like you're saying, see, this reminds me of a very interesting case study that was about Chase Manhattan Bank bagging the syndication mandate for this one, Hong Kong Disneyland, where he is responsible for the credit analysis since it devolves on him. I have noted down your point as well here, as you can see in the box here. Everyone is okay with this, so that we can add. And Ganeshji, what I'm going to do is I'm going to send you across whatever I'm changing here, which can be consolidated.
Sir,
So
I have one point to add with respect to KPIs and valuation metrics. So, what my thought process is, valuation metrics is a very narrow word. So KPI. So just to give you an example, for example, edtech companies there, right? So cost of acquisition of a customer might be KPI, correct? But it's not a valuation metrics. And then probably when and it's a very important KPI. It differentiates between kind of a what at what CAC you are acquiring customer and what is lifetime value of the customer. Yes, for sure, lifetime value of the customer might be one of the valuation metrics, but CAC is equally important where we can go and compare. But CAC is for sure is not a valuation metrics. So I think KPI is a more wider term. That's my thought process. Yes.
So I would say, capturing your point, what I'll say is API should also include valuation matrix. So I'm not, replacing, but I'm, broadening it. Does it make sense? What
Yeah,
would you say,
wonderful.
Ganat?
One
Wonderful.
point, sir, one point
Yeah.
about the merchant bankers. Of course, agreed that they have the maximum skin in the game, but at the same time, it should not be construed as, there should be leading to a mis-selling, because they are responsible for underwriting the issue and selling it to the investors. If they are only deciding the KPI, it may lead to mis-selling. So it's better to have independent merchant bankers who are not the lead managers. This is just one of the views.
Yeah, this cuts both sides, because by and large, those who are, underwriting, they know whether it's going to devolve or not. So their interest is only to sell it. Like if you look at the recent issues, there were big time merchant bankers, and investors have lost. So if they certify, so yes, we have an issue here. So point is whether those who have skin in the games should certify, or there should be independent. That's the last thing we have to decide now. So KPI should also include valuation matrix is one thing. Then the person certifying should have a skin in the game, such as underwriters, which is merchant bankers. What you are saying is that it should be independent merchant bankers. But again, we know how independent directors are also independent. I often call independent directors as an oxymoron. So that's where we are. So we can simply say that, the person certifying should.
Can I add on the
Yeah, I
statute?
think another point when we can mention that of course this KPI should be industry wise or somehow declared by the SEBI that these are the industry KPIs, generic KPIs basically. For example, the user base will be particular to those industries who are e-commerce based and all. And for pharma company there would be other KPIs, and for other industry there would be other KPIs. So then when those KPIs are already declared, then there would be chartered accountants and cost accountants can very well certify looking into and comparing those guidelines and whether the company has followed those guidelines or not.
But who will prepare those guidelines, and capture those?
So in consultations, we can recommend to SEBI. So while framing this document, they can also have a list of annexures that industry wise these are the generic KPIs, and in addition to this, that can also be welcomed and approved separately. But yeah, there should be something generic.
What I think is that what Ravi is saying is correct. That as we start going through this journey, people will start giving their KPIs, correct? And over a period of time, let's say a 3-year time frame, etc., all of this can be consolidated into saying that this is what is the generic KPIs, and that becomes a benchmark reference point in future. We can't say that it will be available immediately, but maybe in future as we get more and more data, correct, with MCA, with such authorities, when we apply this, at that point of time, this can become standards. Yes.
Yeah, fully agree.
So can I just add one point on statutory auditor? See, because a statutory auditor is supposed to certify the financials. If and we say that the statutory auditor does not do a valuation, mainly because then he is no longer independent in certifying the financials, because he's fixing something which is valuation driven. Now, therefore, to assume that a statutory auditor can certify the KPIs is assuming that his audit is not going to be compromised. So that's something which we have to assess. I believe that an auditor who is going to be doing a valuation is automatically compromised in doing the statutory audit. Therefore, I would believe that a statutory auditor should be ruled out for this purpose. My personal view, they do certify prospectus, for instance, but I think that to take out one set of metrics and say KPIs will be certified by statutory auditors it may impair independence. It is possible.
So essentially, you're saying that statutory auditors certifying KPIs causes conflict with his audit job, right?
Yeah, their independence should not be compromised, because when they are doing the audit later on, they should not be compromised because they have certified a set of parameters used for valuation.
Right.
So let me add over here. So I think in terms of a process, when you look into all of these process, so statutory auditor audit the financial statement. So I think last 5 years financial statements are reviewed by the auditor, and whenever there is a error or restatement, auditor does that restatement, right? And this is something which is also opining on the historic financials. So probably though on an overall basis, I still not in a favor of including any more certification, but there is no conflict of interest of auditors.
I also agree
I
with that,
also
sir.
think that there's no
There's
interest
no
of conflict of auditors because see, you can have the auditor for a specific engagement, like they're doing an audit engagement. Well, the level of diligence exercise is different because they're doing test checks, etc., etc. Here, the engagement could be a different engagement, and we are seeing that we want. So let's say that if somebody is asking the statutory auditors to certify the data which is there in the company, well, he goes into the details of the data. He's not doing test check there. So here, the engagement can be different. Yes, we need KPIs to be checked and certified in detail, and they are the best. I feel that they are the right guys to do that because they are with the company for a long time and they know how it is behaving or in touch with the management. And of course, I mean, if we have got an internal audit team, I don't know whether that can also help, but that could be other source also. Internal audit team can also certify the. But I mean, the reliance would be different as compared to a statutory auditor and an internal auditor.
So can we put it this way? What I'm saying here, if you can see this comment, does it capture overall what we discussed? Add independent merchant bankers, right, which we discussed, or simply merchant bankers, valuers, cost management accountants. See, when we say valuers, valuers with the domain expertise. Everywhere the domain expertise will be important. KPI should also include valuation matrix. Statutory auditor may cause, having statutory auditor may cause certifying KPIs may cause conflict with audit work. So it's better to keep the statutory auditor away. Can we conclude and move forward?
Yes.
Thanks.
Yes.
I'm just yeah, we'll move forward. Fair enough. Just one moment. And so that I'm just putting it here, then I'll send the summary. The next
No,
one.
I think so.
Yeah.
Sorry. I think
Yeah.
How does certifying KPI may conflict audit work? That's a wrong statement.
That's see. If I'll tell you. Let me give you an example.
Yeah, sure.
Let's say an asset reconstruction company. Actually, I saw that. I had I had in my statutory audit, a profit was 10 crore for financial year 2014. PAT, it's a small ARC that I was heading, SEBI's. There was, certain valuations based on the credit rating. Okay. And there was some flexibility. Now, the point is that flexibility was allowed me to have that profit of 10 crore. But one of the independent directors, who I wish he had been there today, I should have called him. He made a point, and then the profit came down to 9.83 crore, and I didn't object to that. Right? Now, the point is, when I had done that figure, the statutory auditor had agreed with that. Any such thing, any figure which emanates from KPI will be accepted by a statutory auditor if it has been done by the statutory auditor, although it kind of overstates. I cannot have a very precise example. So it may cause, there is a possibility.
So, okay, moment
this audit firm certifies it, and if that is leading to some kind of a pricing which looks aggressive, he'll have difficult time.
I want to add one point. See, so whenever an auditor is opining, he's opining on number. So now all those KPIs are not numbers. So basically not financial number. They are performance indicators, right? So for example, number of customers, average revenue per user. Or probably customer acquisition cost, or there can be 10 other metrics, right? So an auditor is just is kind of a certifying it for a historic period. So absolutely there is no conflict of interest. He is not undertaking any valuation. He is not giving any opinion. He is certifying whatever is a statement of a fact. So probably this statement is not factually correct, that if auditors does this, it will have a conflict of interest. There is no conflict of interest. I'm not sure. I'm not sure. Are there any other
not a big issue.
Why they don't want to add over here?
Okay, not a big issue. We'll knock this off. That's it.
Even I agree with Mr. Romesh view, because there is no way presently which, how much information can a valuer, suppose any other independent person does it, instead of independent person going inside the company, it's much easier and convenient, and the reliance factor is more if a statutory auditor does. It's done from an investor's perspective.
Fair enough. Fair enough. I knocked it off. Not a big issue. Ultimately, the analyst will come forward and say what is, how credible the figure looks. Next is whether 3-year look back period for KPIs is adequate. Any suggestion on increasing, decreasing?
Well, actually, it will be useful to have 5 years, because if you look at a typical life cycle of company which is going into an IPO, it will go from Series A to Series E, and then it goes to IPO, let's say, which potentially could be over a period of 5 years. It will be good to see how these parameters have worked over a period of 5 years rather than 3 years. 3 may be sufficient, but 5 would be better.
Okay. This cannot be conflicted. What you have said is perfectly in order. But I thought that even 3 years looked good. So what will be our response? It may be made as 3 to 5 years. Leave it to them. Shall we make it that way?
I agree with 5 years. Actually, 5 years is a better. It shows a trend actually.
Okay.
3 years maybe it will be hard to say that the trend is existing in that.
Actually, the market is so dynamic that trends keep on changing.
See, it's more from the viewpoint of trying to correlate, let us say, previous valuations which have been done with the metrics at that point of time. So, for instance, let us say, if you take an insurance company, embedded value was, let us say, 1,000 crores at 5 years back. And based upon some of these metrics, the valuation at that point of time was 2,500 crores. Currently, let us say it has embedded value of 10,000 crores. And therefore, the valuation is 25,000 crores. So you will see how the valuations have moved over a period of time, and the valuations themselves, how they are linked to that. The whole point of this is a disclosure which an investor can use to make his own judgment as to whether to invest.
Okay, so it should be 5 years so that the trends are discernible and the basis of past valuation subscriptions are known, we can say.
Are linked actually.
Huh?
Are linked actually. They can be linked.
Okay. Fair enough?
Yeah.
So all fine. Shall I go for it? Post it?
Yep.
Okay. The next one is now, I didn't make any fourth. Okay. Where is it? Okay. Now we come to fourth, whether comparison with global peers would be appropriate, as some of the KPIs would be relevant for that country economy they operate in. If yes, whether issuers should make comparison with global peers. I think it goes without saying yes. This is an order I'm saying. Nothing to add here. Why not? Do a better job, yeah? I think this was the best. 424 was the fastest.
Can I make an observation on 4.2.4, sir?
Haji, boliye.
See, I think my experience of the classic it is not to demean anyone, the big fours or the other ones. The comparisons used to be the global AUM market is 20% of the GDP. In India, it is 0.1%. Per capita income is, so everyone uses this global benchmarks. The difference is, if I were to segregate India as a country into two parts, I mean, not the political part of it, the practical part of it, and segregate their per capita incomes, and then look at one set of per capita income which is measurable to the international developed markets, then if I say percentage of AUM achieved in that space, we are almost equivalent to global peers. There's no market. The moment I take an average of the entire nation, the number looks so skewed. So it is very difficult. And most of the research reports, if you pick up from 2008, of all the big fours, whatever reports are published, see what they have projected in terms of numbers in these comparisons, everything falls flat, undoubtedly. And I can give it in writing that they fell flat once we look at it. So when we are comparing these global peers, it is very important how these comparisons are made. Just looking at purely percentage of GDP there, percentage of GDP here, penetration of GDP over there, penetration percentage here, it is not comparable in my view. I mean, so to that extent, this brings ambiguity and it unnecessarily inflate and make a forward-looking statement which may not be right.
So
I'm just capturing your point here. What I've written is, this is an order. However, the global comparison should be backed by an analysis of those KPIs as to how they apply to this country.
Precisely. I mean, see, for example, I would think, can we compare the manufacturing cost, etc., of a China company versus an Indian company in an electronics field? It'll be very hard to say. And can we say that China's KPI, if we were to benchmark with India's KPI, they will not be comparable? Another example could be that do SaaS companies sell well? Correct. They are able to market well or go to the customers or acquire the customer speedier in the US market. Yes, that is possible because that market is matured. It is developed and people understand. So they invest in SaaS companies and promote that. However, maybe in India, it's in a different stage of growth or development, SaaS companies. So here it will be very difficult to say, yes, customer acquisition cost in India versus customer acquisition cost in the US. I mean, they will not be comparable at all. So putting global into this will only increase the cost of doing the work, and it will not result into any value add, according to me.
So if at all they're giving, let it be backed by analysis to show how they apply. I just made this comment here. I've captured both the points.
The only fear is it might be misleading, sir. Our concern is it's not about proving that they are comparable. It's about it should not be misleading. That's the fear.
Yeah.
But I think that Ganesh's first point was that first and foremost, and also Sanjay was saying the same thing. Basically, that first and foremost, identify the comparable peer set. Now, that is missing out of this whole suggestion here. They're saying compare with global peers, whether comparable or not is our point. So first and foremost in valuations, what we do is we identify the comparable peer set. Then we take the valuation metrics and then compare. So for instance, in the case of a SaaS company, we know that a typical metric is 20 times of the annual run rate when we are doing a valuation for SaaS at the current moment. So first we try to get the comparable peer set of companies and then compare against them. That part is missing out of this suggestion. Compare against global peer. That's
okay.
It can be an Indian peer also. What's wrong with an Indian peer? That's excluded from this definition.
No, if Indian peers are not available, it says.
Mm-hmm.
If it's there, it is the first thing, of course.
Right.
So our first, first the comparable global peers should be identified.
That's right.
Not otherwise, if you become an outlier and compare, it will have no meaning.
Right.
Yeah.
The typical valuation is done by taking the comparable peer set, arriving at an or a range, and fixing the valuation within that.
Yeah, I'm adding. Okay.
I want to add just one point. Probably, it's good to have global comparables because for sure, Indian comparables, if there are, they might be very good, but kind of a market which are there in India, probably as of now, very few companies are available, and kind of a data which we are expecting for benchmarking, whether that is available or not, and probably considering there are a lot of companies which are listed, and the market depth is in US market is very big. So some sort of comparability is always good, though probably I would 100% agree that that it may create some ambiguity with respect to oral conclusion, but some sort of conclusion is always good, rather than being not to do any conclusion. And yeah, and at the end of the day, see, everyone have to look and filter on their own. The intent of this is not spoon feeding, right? So whoever there is assumption that whoever is looking at these numbers, he will apply his mind. So
That's right.
there is no need to spoon feeding. Whether he want to consider that or not consider that, it's his choice. It's assumption that whoever is looking is an intelligent person. And to be honest, if it is an analyst who publish report, they are far more intelligent people, because they have a sector specific knowledge.
Right.
If someone sector specific knowledge analyst is working on that, he might have too much of data experience of deals and everything. So for sure it is helpful.
Yeah. So as you have seen, I have captured the gist of the discussion. Give figures and let the analyst analyze, come up with their thing. Some analyzed, there will be always biases, significant biases. But once figures are there, there will be fair amount of independent opinions emerging. So I've captured this. As you have seen, how first comparable global peers should be identified unambiguously. The global KPI comparison should be backed by analysis of those KPI and how they apply to the country. I think fair enough. Shall I go further?
Yeah.
Yeah, thanks. Now we go to the next basis of issue price. Valuation of issuer company based on secondary sale, acquisition of shares, equity convertible securities, excluding gifts. Here it is talking of gifts for 18 months prior to this. And the next point is without the word gifts. That's what it's saying. Fair enough. It's good that, it's capturing. Here, the same thing is there. Here, the word gift is missing. So I have just made my point here, and let's quickly look at it. So value of issuer company based on secondary sale, acquisition of shares, equity, convertible securities, excluding gifts in the last 18 months prior to the date of filing of DRHP, RHP, where earlier acquisition or sale is equal to more than 5% of the fully diluted share capital of the issuer company, calculated on the date of completion of the sale in a single transaction or a group of transactions in a short time. Fair enough. He has made a broad bandwidth. My point here is, okay, I didn't make my comment. I thought we will just have a chat, and then I'll just put, where is that? Yeah. What would you say to this? Why 18 months? 5% is good. It's a big number. Probably it could be 2%. Why not 5%? Two things. Should be 18 months look back here for this, or should it be longer period, or from the inception, and whether it should be more than 5% or more than 2% or 3%? What would you say?
Sorry, Sindhu, by mistake, I unmuted you.
Oh, is that so? Oh.
Actually, there was a background noise. Sindhu, you can unmute yourself and go ahead.
Okay, I'll do one thing. No, I'll mute everyone, and you can, if I can, let me just check out. Let me just first stop share so that I can go back here. Let me see if I can. Okay.
Yeah.
Now there is no noise.
Sindhu, actually, I think one participant was trying to tell, and by mistake, maybe I muted her.
Okay. let me go back here. Now here,
We
basis
should go
of
for
issue
3 years,
price,
sir.
huh?
We should go to 3 years, not 18
Okay.
months.
So Rajendra ji, I didn't understand this point at all. I mean, what are we trying to do here?
See, he's talking of past transfer allotment. So he's making a disclosure of the what kind of sale was done in the past to the various investors who subscribed to 5% or more in the previous 18 months, whether equity or convertible securities. 18 months prior to the date of filing DRHP. Now, I'm finding it a bit strange. If you see,
How is it relevant? I mean, totally relevant to the new issue.
it gives an idea of, what at what price the earlier people have picked up. So what kind of valuations have been done?
So
The
let
moment
me,
that happens, you would like to know how those were valued. I'm wondering why it's talking of 18%, 18 months. Because when I wrote this article on Paytm, I went to the RHP, DRHP, and I found that all the fellows were mentioned. Let me just open that. Allow me 1 minute. Meanwhile, you can mull over it and talk about it. Allow me 1 minute. I'll just get that.
so let me
And-
share my experience with respect
Yeah.
to such deals. So there are a couple
Yeah.
of things which are there. And I'm only pointing with reference to transfer of shares.
Uh,
So one is, all of these investors who are at least early investors, they might have a limited holding capacity, and at some point of time they want to exit, and whether the exit is at a discount. So first, and then there are also ESOP holders. They want to have some liquidity before IPO, which is going, and we have seen that probably there is significantly discount, and probably in some of the cases we have seen is as high as 50% discount to the current price. So only limited point with respect to transfer of shares. This should be higher slab. Instead of 5%, it should be 10%, for the two reasons. If someone, so for example, fund is holding, a holding period of a fund is 8 years, and it can't go beyond 8 years, so he will do a fire sale. No one can stop that. And how company can have an influence of that particular holding period? And similarly, we have also seen that ESOP holders also tend to exit even at a significant discounted price to the fair value, and have seen probably more than 6 to 7 cases in multiple unicorns.
The issue
And-
is, the reason is, just like ESOP holders are, I won't use the word, but just for the sake of discussion, at a mercy, or they believe that they should get the liquidity and they should get out. Common investors similarly come under the bracket. The point here is, I don't remember the company name. Again, I'm bad in memory. Recently, there was a company which came into IPO and also got listed. But just 1 year back, an international company has invested at a particular price, and the listing price is 5 times of that in 1 year. I'm just forgetting. This is just recently, last 2 months, if I can pull out. 5 times. So 1 year back, this international company has invested, and within 1 year, it got listed. Now, the importance here is the listing company comes with a wherewithal and the capability which can enhance this particular company, and therefore the valuation can increase. It is justifiable. But when the disclosure is required, ensuring that people are knowing what is the price they have come and what the investor's valuation is. So to that extent, is disclosures are required, and whether it is 18 months, probably I should consider it as 3 years, because we are talking of the startup companies which are actually not having any positive numbers. It's all the ambition of future. When it is ambition of future and the risk elements are so high, the disclosures also have to go a little longer, in my view.
Okay, very, very, very good points which came up. I just had one more thing. Now, secondary sale, when it happened, somebody picked up. You just mentioned that, somebody picked up and later on it was listed at 5 times. So that information can be given. Why should that serve as a basis for the issue price? That can be one of the points. But ultimately, if it happened in the last 18 months, is fair enough. If it's too far off, it's very old, probably it may not be relevant. So I feel, my personal feeling is that 18 months is good enough. But this should be just to, by way of information. This cannot serve as a basis for issue price. I think this is what you wanted to say, Mr. Ganesh, right? This
But
cannot
this is
serve
actually-
as,
But this is only disclosure, sir. If you see the
there should be
title there-
disclosure, but not serve as a basis, right?
But the basis is actually we are talking about disclosure only. If you see the title itself, it says shall make disclosure of. So I am talking purely as a disclosure only.
Okay, fair enough, fair enough.
So I think that what some people are, what I think SEBI is trying to get to is that can the transfer price be artificially inflated, and then you go to IPO. So suppose
Yeah.
share which is inherently worth 100 rupees is there's a transfer taking place at 1,000 rupees, and then the IPO is done at 1,100. So now to prevent against this, I think that the disclosure itself should also try to show who are the locked-in investors and what they have acquired versus the unlocked investors and what they have acquired. Because there is a set of people who are shown to us as being qualified institutional buyers or large investors who are holding the shares and who are locked in. But that lock-in period is only 6 months. So the moment the 6 months is done, they are out of the issue. So they've bought it, let's say 1,000 rupees. The investors have bought the shares the retail investors have bought the shares, and these people have exited within 6 months, and then the issue price falls. It goes below IPO. How to protect against this in the issue price computation?
Okay.
I think that there has to be disclosure. Your point is very valid.
Okay.
It should be basically a disclosure.
Yeah, it should be disclosure, and it can't serve as a basis. Although the heading says basis of issue price, so he is trying to imply that this can serve as a basis. So we can say that, well, this can be pure disclosure. This can't be basis. That's one. That's
Right.
one.
I'm
just adding this.
Abram's statement here. Abram sir, in my view, I think this is not captured in this discussion paper. The offer for sale should be restricted, especially for certain qualified.
We will add that. We'll add that also. So one is this should be pure disclosure, not a basis for issue pricing, right? How about 18 months? Good enough, or should it be from inception?
So if you have the other metrics which establish valuation over a period of 5 years, what has transpired by way of transfers, we're not really interested. 18 months may be enough, I think, my personal view.
Okay. I would go for
that becomes that's recent, of course, which is okay.
I also think 18 months should be okay. The reason is that what happened, let's say 5 years back, may not be very true. I mean, it will not be. It cannot be related to the current situation immediately. Correct.
I would only go for 3 years. The reason for me 3 years is whether I can capture a trend. See, so because there would have been some people who have exited 3 years back, they would have come in, and again after 2 years later they exited. Someone else came. Like, let's take the example of even Flipkart. We have seen people coming in and going out, and finally it is settled with Walmart. So there was SoftBank, there was Tigers, at various points. So one is disclosure about the recent transaction. Second, seeing is any trend coming up kind of stuff. So maybe 3 years may be better in my view. But otherwise it's okay. I was just looking at the trend part of it.
Okay, so we can say 18 to 36 months period.
The intent is to capture the trend, then rather just disclosure of the recent transaction. That was my thought in my argument.
So let's settle what period you're saying. 3 year period.
No. Intention is not 3 years period. I think as Abram sir already said, 18 months good enough captures. But if a trend is getting captured for 3 years, where 1 or 2 sales are happening, that is a good indicator probably in my view. But I would leave it to other experts.
No. Here I'll make 2 quick points. One, 18 months or 3 years or 5 years, information is all available. So you can simply pull out and give. So we can simply ask 3 years because that could give better indication of the trend. Anybody can use it.
So what is the frequency at which the company raises money, correct? So is it 1 time or 2 times that they would have raised in 18 months? And if that is not sufficient, then probably extending the period would be a good idea. So the capital infusion, how frequently a company would need, correct? That will give us the requirement of injection, correct? And 18 months, it's hard to think that there'll be a lot of injections that will give us trends, etc.
Yeah. Point. So 3 years looks to be good. Fair enough. Now, the last one is whether it should be 5% or it should be less or more.
I think 5% I think is more a standard norm, unless I'm not much familiar. Unless Abram sir,
See,
I think one of you mentioned it should be 10%, but 5% is pretty big, right? Sometimes, it depends on the size of the deal.
So if you take a large issue, sir,
Yeah.
in terms of valuation, it is at, let's say, some 25,000 crores when it is going to IPO. And the size of the issue is, let us say, 5,000 crores, or whatever it may be. Now, if you're talking of 5%, 5% may be 1,250 crores.
Yeah.
The investors who are coming in and which they are saying as we have got qualified institutional buyers are 250 crores. None of these will be mentioned. So the reason being that as you get closer to the IPO, the amount which they can invest will drop. It will be definitely below 5%. It'll be 2%, 1%, etc. So if you don't capture that, I mean, why this 5% limit is again a question. Why not 1%? Or why not something which is relevant?
Okay. And the data are all available. So why stick to 5%? Expand it. So
this is I'm just curious and seeking clarification from this group. This 5% we are talking about the valuation of as of DRHP date, or whenever a transaction has happened. Suppose the transaction has happened 1 year back, and at that time one investor who has say 5% stake selling to another person is a secondary sale, not a primary sale. We are talking about at that time whatever the valuation 5%. We are not talking about the DRHP dates valuation, if I understand correctly.
Now, this is all historical.
Because in later rounds, it'll be less than 5%. That I think we have seen, right? So
I'm wondering where this comment has disappeared.
So we are capturing it here. So you can summarize it and capture it.
Fair enough. So 36 months. I made comment. I'll see that later. So we said it could be 36 months. And the percentage was to be decided. Certainly, I don't know where it is. Now, the percentage was the last thing that we were discussing. So what is that figure you're talking of?
I think anything more than 1% for the late, I mean, these companies which are going to IPO is actually relevant.
Right.
My personal view, you can, of course, put what you feel.
No. Ultimately, we are coming to a consensus that we are not debating. We are just adding points so that we can. Okay, now, where is this?
See, because if you take a valuation of 25,000 crores, 1% is say about 250 crores. And these are all targeted towards retail investors like us who are putting in 2 lakh rupees. So will it not help me to know when, see, the 5% limit is automatically making it 1,250 crores. Who's going to put 1,250 crores?
Right. In big issues, it becomes very, very.
So I had a question rather, on this point, is that based on past trends, if people can share, what is the percentage that the promoters offload to the new investors, or what percentage transaction takes place? Typically, when I've seen people coming in for 5%, 10%, or 20%, correct, for example. So is that, so we can make a generalization based on, okay, before going to the IPO, this is a kind of offloading that happens by the promoters, and that percentage could be relevant here, rather than thinking about 1%, 5%, 2%. If we put it that
So
way.
Sanjay, I think you're right. See, in early stage it is 5%, 10%, 20%, which is Series A, Series B, etc. But Series E, etc. are definitely less than 5% per investor.
Much less than 5%. True.
Shall we say she should be 1% or more, not 3%, 5%, right?
Yeah, I would think that would be more relevant for this to achieve their purpose.
Fair enough. No point, no problem asking them more, Fair enough. This I'm posting. We go to the next now. Okay, next one was, same thing without that gift. Same thing applies here. There is no difference. Same stuff. I don't know why they made this big distinction. Does it make a big sense? I do not know.
One is a secondary sale, one is a primary sale.
I'm sorry, I missed out. Primary sale. Fair enough. What are the views on this primary sale? See, if somebody comes at 4%, as one of our friends mentioned, big issue, even 1% becomes a big amount. Now, if that has set a new trend, it will be missed out if we keep 5%. Same thing will apply here.
So in the primary case, the money is coming into the company. No one is exiting and benefiting it. So I think 5% is good, and the period can go to 36 months in my view, sir. In a secondary sale, people are making money or exiting. In a primary, the money is coming into the business. So people are ready to take the risk. And therefore, again, since it's a pre-IPO, we are talking about big investors only. Then maybe 5% and 36 months or 3% is also okay. I mean, I'll leave that again to hear everyone.
The only point here is that, this is coming under the basis of valuation. Now, if you look at even 197, the latest entrance was at 1,800 rupees plus share, about 1,880 rupees per share. Right? And it seems that, the 2,150 was fixed to give him some kind of return without even mentioning that. So the moment we are talking, so that is primary only. I don't think he made a secondary. He added further capital into it. So it's quite possible, that this can be used to mislead. So at least the whole information can be given. So 18 months looks good, but should it be 5% or more? Now, only two things here. Period, the look back period, and the percentage. That's all. We need to have a consensus. So look back period. What would you say? 18 months or 36 months? Actually, the entire history should be given. What's the problem? Should be inception, right?
Yeah.
Even currently, they are giving the entire history.
Yeah, they are giving inside history. So it should be since inception, we can say. That tells you how the new entrants have valued it. The valuation has gone up, means it induces confidence. And second, 5% or 1%, what is it like?
I think that, see, for primary issuances, I mean, maybe the same percentage would also be making sense.
So 1% or more, right? Same as we did in the previous, right?
Yeah.
Okay, thanks a lot. Okay, next we look at, with reference to about 2 points, disclosure of floor price and cap price being. See, this is a problem here. Based on that, he's talking of, so this is the basis for declaration. So we are making very clear that this should be only for, so here we have made it clear that, this 1 and 2 above should not form the basis. That should be a fresh valuation. Point here. See, with reference to the above 2 points, 1 and 2, disclosure of floor price and cap price, so many times the weighted average cost of acquisition.
So he is giving the details of what he's asking for disclosure is, suppose if there has been a primary sale, say 1 year back, and if that particular sale had a floor and a cap, they're asking you to give the floor and the cap of that. I think that's what the intent is. That's all they're asking. That's the only disclosure they're asking for.
Yeah. So Ganesh, it's like this. Suppose I've acquired shares at 1 rupee per share. And then in the last round, I acquire shares at 10 rupees per share. My average cost is 3 rupees, let's say. But the investor is seeing 10 rupees as being the last price at which I purchased. So that's why this average price is important. A weighted average cost of acquisition for the investment.
Okay, this is nearly the figure. But point is here, why is talking of floor price rupees, cap price rupees, as if it's meant for the issue now, as if the new issue is going to be on this basis. It gives that kind of impression. Is it really that?
No, I mean, sir, I think the floor and the cap, you are referring to the DRHP floor and the cap, right?
Yeah, that's what I have in mind when I'm talking about this.
So essentially, are we saying, suppose 1 year back, I have my cost of acquisition, say, was 10 rupees, and now the floor is say 25 and the cap is say 30. So essentially, we are saying it is 2.5 times and the 3 times, which the recent 18 months what transaction has happened for the investor. I think that's what I understood. I'm saying, is this what you're
I think we'll leave it at that without any comment, because he's simply, he's summarizing what has happened in past. He can pass it over. No comment here.
Yeah.
Right?
Looks good.
Yeah. Let me just make it here.
So one information whether we should ask, which is not here, is the liquidation preferences that are there typically in the cost of acquisition. If I were to simply look at the cost of acquisition, remember, I think to our other colleagues here in BBA, we have seen using backsolve method, we can actually estimate the true cost of acquisition if we were to adjust the liquidation preferences, right? So that doesn't get captured anywhere in this discussion paper till now. Should it be captured?
How will it impact the valuation?
Because suppose if I am as an investor, I have invested in the last 1 year on paper at a price of 20 rupees. Okay. And in the DRHP says the floor price is say 22 and the cap is 25. So it looks very correct that investor did not really make money. He's coming at the right time at the right price. But the 20 rupees came with so much of liquidation preferences that the true price could actually not be 20, it could be 5. If we were to adjust for liquidation preferences. Am I right, sir? I mean, that is the reason why I said, while they simply said paid cost of acquisition, what is this cost of acquisition? Is it a pure play cost of acquisition of a common share, or is it it is including all the put options and such rights you have, embedded rights?
Okay. So that probably could have come in the previous points here. Here we can say this. Can we add it here itself?
Since we were referring to a cost of acquisition here, I was mentioning, because cost of acquisition prima facie without removing the cost of embedded rights has no meaning.
Yeah. So what we can do is here in this here, we can add here. In this itself, we can add what can be the cost of, this should also include I'm just writing, you can just add. But do you really feel that this kind of so many embedded options are very prevalent? Include?
Yeah. I think that typically before an IPO, Ganesh, say some of the small IPO, SEBI was trying to work out how to do a small IPO. And the investors, the big investors at that point of time were trying to carry the rights through the IPO process and have embedded rights like you're saying. However, SEBI's view at that point of time, still at that discussion stage, was more that they should all get converted before the IPO. And typically, if you look at large IPOs, all of them are converted pre-IPO. So rights no longer continue preferential rights in nature over and above the incoming investors.
So I have added here in that This should also include cost of embedded options explicitly with details.
Yes. So Abram sir, the reason I said is they will get converted. The question is ki when you are talking about this particular last 18 months or 3 years, what has been your cost of acquisition? What value you will put in? I mean, post all this rights removal, the final price, what comes in that you put in, or
It will be, I believe it's weighted average cost of acquisition as converted.
as converted, right? Okay, okay. With no rights. So essentially, that is the clarification I was seeking here.
Yeah.
Shouldn't
The
we ask that?
valuation of issuer company itself would have taken care of the liquidation preferences and then derived, no? So basically these points would already have covered when we derive the dilutive share price, it is already considering the rights of the shareholders, and then the valuation of the company is looked at.
So in the point 2, if you add that, this can be, it's first of all in the point 2 here, the previous one, it is, implied that even liquidation preferences are captured here. But we are additionally saying, emphasizing this by adding this.
But disclosure of all these preferences and all would be a little too much to ask. No?
We are not asking for disclosure of preferences. I think the point is key, as long as the cost of acquisition, which is the intent here, is exclusive of any of this. That's all we're saying. If as Abram is saying, everything goes as of converted date, all rights goes away, then that's the cost of acquisition. So the disclosure of the cost of acquisition is limited to only that it is a pure play cost of acquisition without any other embedded rights.
So
We don't want
coming to this 3, Ganeshji, your point was captured in a previous point. Now, shall we add something here or move ahead? See here I've just added here. One moment. This should also include cost of embedded options explicitly with details. 2.
No, I'm saying the other way around, sir. Whatever price of cost that we are referring to, that should be a pure play cost. That's all I'm saying that. So the disclosure has to be saying that this is my cost per share. We don't want what options behind the scenes. As long as they say that this is my cost per share, that should be a pure play cost.
So, okay.
As Sindhu is saying that we are not interested in what liquidation preferences, what disclosures, we are not keen on that. We are only saying that it's pure simple disclosure, cost per share, which is comparable. And Abram sir, as he's saying that it's normally after conversion as per SEBI, this will be a pure play share. If that is the case, then we are good to go there anyways.
Will this be okay? But this will not be enough. What would you like to say here? Let's paraphrase. Are you able to see the pop-up block?
Yes, sir.
Yeah. So what would you like to say? Or how would you like to paraphrase it?
I will just say that the weighted average cost of acquisition should represent the cost of an ordinary share.
One moment. WSCA
should represent.
Others
can throw some light. I mean, this is my view.
Yeah, should represent
the true cost of ordinary share.
Okay. Fair enough.
Abram sir, are you saying ki as on the date of DRHP time, no convertible instruments such things cannot continue after that for investors?
Yeah, typically it will not be there, no, because reason being that I mean, they hold the rights only till they get to IPO, because once they get to IPO, they want to exit. Typically,
no, whether they want to exit is one, whether the rights continue if they have as an instrument.
So they get converted to equity. If you see most DHRPs, no, you will see that all the preferential shares have got converted. So they're all common stock. They're all equity shares, typically. The only embedded, like you're saying, options will be employee stock options, which are there, if you look at typical prospectus.
See, I remember for a real estate entity, they had put options, and then the rule came up that the put option right for an investor post the listing cannot be there. That I remember for a real estate entity, the put options to be there. But a convertible instruments, I mean, if they convert before the IPO, that is their choice. But the rights of a convertible instrument, will they extinguish if they don't
Yeah,
convert?
they're all extinguished. SEBI ensures that, no? I mean, when they approve the prospectus, typically they do that, is what I understand.
Okay.
Okay. Thanks. That clarifies the thing. So take this comment takes care of it, right?
Yes, sir.
Yes, sir.
Okay. We go to the next now. Issuer shall offer detailed explanation for offer price, cap price, how many times of the those primary issuance price, secondary transaction price, as stated in the table above, as the case may be, along with comparison of the issuer's KPIs and financial ratios, EPS, P ratio, RONW, and net asset value, etc., for the last two full financial years, and interim period, if any, included in the offer document. This will enable investors to have a comparative view of the KPIs. Now, this is very interesting. So if you are allowing new age technology companies which have lost, this financial ratios will have no meaning. As far as this statement is concerned, I have only one point here. Past history you are given. Now you are saying that, okay, all that, offer cap price will be based on the past. Very good, no issues. But if it's a new age technology company with losses, does it mean that they will not be able to come out with any issue if you go by this? Okay, one moment. You give me 1 minute. I'll just come up with this here. See this guy, basis for offer price. You are able to see this? Brand value reach. See, these are all, qualitative factors. Quantitative factor, he says, financial information on page 269, which we are aware of it. But there is no ratio here, right? And then all this he has given, all EPS are negative here. So, okay, he has given weights for the latest is 3, then second 2, the previous year, and then the third year 1, and the weighted average is minus 43. This is what he has given. Price to earning ratio, then obviously there is nothing. Then industry P ratio, he says there is no listed companies and all that stuff. Accordingly, it's not possible. Return on net worth, same stuff here, minus 37. Net asset value, 104. Obviously, it was, listed at premium. This is what it was. And comparison with industry peers. Now, when you look at this and then go back to this, you find one problem here that you're giving all that. But this really has no relation to the issue price. How to link this to the issue price? Again, we'll read. Issuer shall offer detailed explanation for offer price, cap price, as so many times of the primary issuance price, secondary transaction price, as stated in the table above, as the case may be, along with this. So the point here is that with all this rigmarole, you are really going back on the primary and secondary issue price, the floor and the cap. This is becoming perfunctory, these ratios, like in case of the 197. So what are we trying to do here? This is a very major component I've not made any comment. Let's have very crisp point and mention here.
So I think here what they're saying is they're asking the management to give an explanation whatever past transaction have happened of the primary and secondary price vis-a-vis the current floor and the cap. So this is perfectly fine in my view.
And this is just a disclosure requirement. No? So the public will have some data available to be able to see and take a decision whether they are interested in investing or not. So I think it's just
Yeah.
Okay. So you feel that this will not be something like,
yeah, when we see Paytm's ratios, we would definitely not be so keen on investing, probably, when we see every there is nothing that we have on hand to actually take a decision.
will you back in a few minutes? Hello. Okay. My only worry is, let's see as we go. So right now we are not making any comment on this. He will not have anything to say. If you were to really look at the Paytm, he will have nothing to say. We don't have anything. Okay, those you can refer to those papers. This is what it is. My EPS is negative. My RONW is negative. But yes, I have a book value. Of course, that is talked of book value. P ratio is irrelevant for him. So this is, of course, it will be irrelevant here.
Just a time check. I mean, are we extending this, or how long this? How much more is remaining here?
No, and we can. I think the next 10 minutes we close it now. Then we have come to 6th page now.
Okay.
Not even 10 minutes.
Okay.
That finally is whether 18-month look back period is for the past transaction, and this thing is good enough.
So we already discussed that. I think we have taken.
Yeah, we mentioned. I had mentioned it. This should be from inception. So we already mentioned it. So 36 months, etc. We had mentioned, right? So I'll retain it as inception itself. Now, just last thing here. See, this is what will have to be done. Now, the last thing here. See, with all this drama, we're still not clear whether the basis of offer price, what new thing is there. That's the only last thing here. Issuer shall offer detailed explanation for, I'm talking of this 4th point. Issuer shall offer detailed explanation for offer price, cap price, being so many times of the primary issuance price or secondary issuance price. I still, get a feeling as if that price is to be justified on the basis of 2 things. One, the past pricings for secondary and primary, and the second one is the ratios. So there is no fresh ground which is being broken here. That's the only last thing. And we can just put our comment here and then close it in the next 5 minutes.
I personally feel it is okay as long as they're able to compare with the last, we said 3-year transaction or inception, and they are, end of the day, as someone's rightly stated, analysts and the people have to then do their work of reading this. It is not management's responsibility to spoon feed also. So to that extent, as long as they disclose this, which is good to go. I mean, in my view.
So how about saying that, okay, the last thing here, I had mentioned here that only the companies which have demonstrated profitability should be allowed IPO. Right? What would we say here? Finally. And of course, you're mentioning of OFS. That has not come here.
Yeah. I mean, that's a parallel thing. OFS is something I feel that there should be a lock-in for certain kind of investors of certain sizes for some period post IPO for price discovery to settle. The principle and the intent is the price discovery cannot happen just at the time of IPO for a new age technology companies. It requires some kind of a stability. And from that perspective, OFS should be restricted or they should be locked in for certain time. I think it is 6 months is somewhat, I think Mr. Abraham was saying, I think that should be a little longer to get the price discovery.
The new fellow who comes, certainly, let's say if I subscribe to the OFS, why should I have to suffer with a lock-in?
Not the new fellow. Lock-ins are for the old investors who have been with the system. See, today, the recent trend of couple of investments we see, 80% is OFS, 20% is primary issuance.
Yeah.
So, new age companies, since they are not exhibiting demonstrable profitable parameters, and it is an ambition and it is a little longer. So therefore, my feeling that OFS should be restricted. How it can be done, I'm not sure. But OFS should be restricted for certain period post IPO until post IPO. So if Nykaa came in, where 4,500 crores was the OFS and 800 crores was primary for the capital inside the company. That's huge. They should, if they would have come just for 800 crores and let OFS not be there for 1 year, after 1 year, they have a luxury. Market would have done a price discovery and let them exit. The true value makes it more, let them exit at the higher price. That's my thought.
No, we'll add OFS should be allowed, permitted only for the companies with profitable operations. At least for how much?
I don't use the word profitable operations. Demonstrate price discovery, say for a 1 year or 12 months, we should wait or something. After
One is profitability, another is price discovery. So first, are you okay with there's these kinds of loss-making companies coming up with 21,000 rupees per share kind of? What are your thoughts? I'll just put your thoughts. OFS should be permitted for whom?
It becomes difficult to even determine what is the level of profitability. I mean,
No, if they have a profitability, if audited accounts show, then it's fine.
yeah, but for the sake of showing, if it is just a 0.5% profitable company, that would again, it is a very relative matter.
So if it's say 1 year performance, then they'll somehow manage to capitalize some expenses and show profit. But if it is kept for 2 or 3 years, then it's a different matter. Though of course it will be difficult for the other lobbies are also there. But what is our point here?
So I would limit to saying that keep 1 year is just the cooling period. After 1 year, OFS, whoever wants to sell to whomsoever, they can do it.
So after 1 year of profitable performance?
No profit linkage, sir. After 1 year, everyone knows everything, they can sell it. The price discovery is 1 year time, probably. You don't need to link it to profitability, because then it's a secondary market sale.
Price discovery means after 1 year of what?
IPO listing.
Who will sell? Who will sell?
All the existing investors who were prior to the IPO were part of the company or with certain percentage stake with them.
I see. So what you would say? You would say that investors. So in other words, you are saying that they are not allowed to do OFS right now in the IPO, right?
Yeah, of certain size. That one can.
So what you're saying, OFS at the IPO stage. No, that's why, at the IPO stage should not be permitted. That's what?
For 1 year. At least for 1 year.
Blanket or only for the loss-making company?
Loss. Probably loss-making companies.
Yeah. And thereafter, why OFS? Then he can sell in the secondary market itself. period.
Yes.
That's all.
Yes, sir. Amit.
I'm
Let
just
others-
others we can note down. I'm just saving it and stopping it. So I'll send you this one and I'm closing it and we'll just conclude it also because we have exceeded the timeline. Thank you very much, everyone. And thank you, Ganeshji. Thank you, Shilpaji, everyone. Any points we want to further have? Or I think many people were busy. They have gone away. From 28, we are down to 17.
Yeah, that is why we normally, initially we used to have 7:30 to 9:30 sessions, but then we off late, we started to make it 7:30 to 9.
I think we'll stick to that. Fair enough.
Yeah, that's fine.
Thanks a lot.
I request Mr. Ganesh Ramani to extend a formal vote of thanks for our today's speaker.
Yeah, thank you. It's my pleasure to give vote of thanks to Mr. Ganatra ji on behalf of Bangalore Value Association. I think, sir, you very well started with the concept of due diligence, which is actually a big thing missing in the new age technology companies, which do not showcase demonstrable profitable parameters, which actually results in probably unknown territory a common investor is entering when it is coming to an IPO with uncertainty of what would happen to their investment that they're making. And so you also talked about the quantitative disclosures, and I think the feedback that a couple of participants gave with your inputs, essentially the linking the promises and to their performance. I think that's important. That such disclosures, if they're there, it will help a common investor to be able to take more knowledgeable decision or informed decision when they're going for such kind of IPOs. You have navigated through various aspects in the discussion paper in detail. You allowed participants to come and through your experience behind what you have been doing as part of your research. We really would like to thank you again for coming and giving your inputs. So thank you, sir. Thank you very much.
Many thanks, everyone. I've just sent you that file which I put the comment on the WhatsApp. Thank you very much. Have a nice time. See you sometime later. Bye-bye.
Thank you. Thank you, everyone.
Thank
Bye.
you, sir.
Okay, thanks all for a patient listening.
Thanks, sir. Bye.